Yeah. So actually today we have chosen a topic called Future of Indian Real Estate, maybe from an alternate investment perspective. So with this, actually, I would like to a session to be just taken forward by Mr. Nitin, Narayana Lal, and Aryaman Vir. You could wonder who are all they, right? So because actually just big shots can't be just seen every now and then. So we are delighted to just maybe thanks to COVID, we could just come out of the number of webinars. And because of the webinars, we are able to just bring many veterans to the doorsteps of the investors. So with this, right, Adarsh, why don't we just introduce the speakers to our investors?
Thank you very much. Good evening to all the investors and my respected panelists.
Very good morning.
Oh, I'm sorry. Good morning. I'm actually in the evening mood right now. Apologies for that. I would like to invite all of you, but I cannot go ahead without introducing each and every one of you, because all three of them that are here in this room are barons in the respective alternative investment space, which has been doing really well in recent times. I think as Vanita ma'am clearly mentioned, there is a large market cap and there's a lot of potential that lies in the alternative investment space. As a matter of fact, we've seen a $2 billion investment in the office space and the industrial and logistics space as far as alternative investments are concerned. It is huge. And I cannot go ahead without introducing our first panel, one of our first panelists, who will be Nitin S Anand from Smart Owner. He's the head of products. He has quite a resume, so to speak. I had to look for it on the internet myself instead of asking him. He is the head of products at Smart Owner. He finished his schooling in Little Rock Indian School and DAV Boys Senior Secondary School. He got his bachelor's in engineering from Anna University. It's actually funny because he has moved from engineering to finance and he has done that seamlessly, so to speak. He joined ICICI Bank as a relationship manager in 2005. He joined DBS Bank as a wealth manager and soon became a treasurer's relationship manager by 2012. He joined IndusInd Bank, where he was the regional investment counselor. And in 2015, he made a major leap and joined Smart Owner, with whom he's been with for the last 7 years. Smart Owner is one of the fastest growing alternative investment companies. And this was exactly where things get very interesting. I'd like to welcome Mr. Nitin. Thank you very much for joining us.
Good morning to everyone. Thank you very much, Team C Profit, for having me here with yet another series of your webinars.
Very warm welcome. It's a real pleasure to just have you here, Nitinji.
Pleasure is mine, and along with the other panelists here, good morning to everyone.
Thank you very much. I think Smart Owner has been into commercial real estate and all kinds of investment options. They have come up with so many innovative investment options in the alternative investment space that all of us must be aware of. And for those that are not aware of it, I'm sure you'll know what it is by the end of the session. I'd like to move on to the next one of our next panelists, that is Mr. Aryaman Vir, who's the CEO and founder of Myre Capital, one of the other fastest growing companies in India. It was only started all the way back in 2020, and they've experienced such tremendous growth. Mr. Aryaman Vir has always been into both technology and finance, from what I've seen. So it's quite natural that you'd see both of them come together. It's quite natural for him to work on something that is both technology related and finance related, particularly in the real estate space. He has an undergraduate degree in network and social systems engineering. He holds a master's degree in systems engineering from the University of Pennsylvania. And he was also a recipient of the famous Quickla Award. He was recognized for his efforts in the School of Engineering and Applied Sciences, which is very nice of him. And he also worked with a Nobel laureate called R.K. Pachauri, which is absolutely brilliant. He researched on green growth and urban development and even wrote a paper focusing on inclusiveness and profitability through sustainability in developing countries. He has worked for major companies like SoftBank, Moilis, and Anarock, which is truly brilliant. And Myre Capital is one of the new companies which truly focuses on something called democratizing real estate ownership through fractional ownership. It's truly brilliant. Thank you very much for joining us, Mr. Aryaman Vir. You're free to.
Yeah, thanks, Adarsh, for giving the introduction. Looking forward to doing this conversation on this platform with all the esteemed panelists as well as yourselves. Like you said, it's a very interesting space. So we'll get into all of that in a moment. But overall, it's been a great journey, and there's a lot more. We are looking forward to this year.
Thank you very much.
A very warm welcome, Aryaman, and thank you so much for just accepting our invitation.
Absolutely.
Now moving to our final speaker as part of the panel, it is Mr. Narayana Lal, the co-founder of Aasthy. He has been into the entrepreneurial side of things for a long time from what I've seen personally. He holds a bachelor's degree from Christ University. He finished a course called Negotiation Mastery from Harvard Business School online. He has quite a lot of experience. He was a financial analyst at Hewlett Packard. Then he was a market analyst at Reuters. Then he was an assistant vice president at JP Morgan from 2005 to 2013. He was the founder and CEO of Brongo, a real estate broker aggregator app, till 2020. And he became the managing partner of a company called Turner Consultants, with whom he was with from 2013 to 2021. And now he is the founder and CEO of a company called Aasthy, which deals with affordable real estate investments in the residential space. Thank you very much for joining us, Mr. Narayana Lal. You're free to share your thoughts.
Morning. Thanks a lot for the long introduction. Just a small correction. I'm the co-founder here. I'm not the CEO in Aasthy. Vanita, Adarsh, thanks a lot. Looking forward for this discussion.
Yeah, very warm welcome, Narayan. Actually, just thank you so much for accepting our invitation and being here.
My pleasure.
Back to you, Vanita ma'am.
Sure. Just give me a moment. I hope my screen share is visible.
No, it's not yet.
It's not it. Just give me a minute.
Yeah, it's visible now.
Thank you. Actually, let's go ahead with the panel discussion as planned. And maybe investments in alternate real assets have increased by 26% in 2021. Actually, this is when everyone was just relaxing during COVID period and was worried. And I think that actually just many people underestimated this particular sector. But sector is just beyond all those things. This is one of the sector which recovered in a very big way is what I would say. So the very first question here is, how has the Indian real estate market performed so far? And how will it perform in the coming years? So obviously just none of us actually just assume the kind of return it could deliver in 2019, whereas actually just today by 2022, it has already just delivered a 26% whopping return. And Nitin, we would like to just hear from you as to just maybe just how the real estate markets have performed that is during COVID and post it, because we have been talking about COVID and now we are just almost out of it is what I feel. So just kindly take this forward, Nitin.
Thank you. Good morning, everyone, once again. And I'll just try to keep it as short as possible. We may not be able to cover everything in this short period. So when we started off in the COVID period, of course, there was a lot of media attention towards real estate, and a lot of it had to do with the perception that real estate is dead. They were, catchphrases that commercial real estate is done with. And what we also looked at that point was we broadly segregated the sectors into commercial, within which we had different sectors, subsectors, which we could look at the hospitality and hospitality sector. And then there was the retail commercial. Then you had your office space, office grade A, office commercial. And then we had the residential and also warehousing, if we look at it broadly. And one other key sector that we were also quite actively involved in before the pandemic has been the managed offices business, and which was our first foray into commercial sector in the 2017 year as well. So when we looked at COVID, there was obviously an impact on hospitality sector on an immediate front and also in the medium to a medium-term basis, where purely because of these sectors being dependent on business travelers as such, there was an immediate impact on that, and we did see that it would last on to a couple of years before this hospitality sector would try and recover, and that we did pan out. We did see it pan out during 2020, 21, 22 as well, where there was drastic impact on revenues as well as assets themselves were shrinking at that point in the hospitality sector. And largely what we also saw was the retail commercial. Retail commercial also because of from the perspective of safety of individuals, the fear of pandemic, fear of infection did keep people away from malls, retail stores. But what transpired at that period is there was already a slight shift towards e-commerce and was what we saw during the
Nitin, your voice cracks in between. Yeah, I think we have missed you completely.
the
Yes.
tier 2 cities as
Yeah.
well. So as a result of which, there multiple things happened with the growth in tier 1 cities market share as well, plus also the tech industry, which had anything to do with e-commerce, cloud computing, and technology that supported all these industries. They saw a huge rise in revenue, which also translated to a large-scale hiring on the commercial side. On the employee side. If we see any of these companies like the Amazon, Microsoft, Google, all of these, and also a lot of peripheral companies which dealt with these industries and which supported these industries, we see a large-scale hiring. And another important thing to look at during this period, what transpired was where was this hiring done? What kind of cities? What kind of salary levels? What kind of manpower were hired? And if you look at this, largely cities like Bangalore, Hyderabad, Chennai, Pune, these have been the cities that, from our side, we've looked at these cities as being a lot more robust and faster growing compared to the other larger cities that have been in India, like Mumbai and NCR. So our focus again has been more on these cities like Bangalore, Hyderabad, Pune, and Chennai, where a lot of high-skilled, knowledge-based tech talent has been hired in this period. And coming to the commercial office space segment, we did see that the immediate period of 2020-21, though we did predict that most of the large companies may not really downsize their offices, because the cost of real estate in most of these cities is not a significant factor for most of the companies. It's the effort and mind space to offload and again set up new offices. That's a big factor. So as long as it was not very expensive real estate, if you look at Bangalore's Outer Ring Road, Airport Road, they're still in that around that $1 to $1.25 per square foot per month range for monthly leasing, which is a fraction of the overall cost of these companies. For them, the bigger factor was always talent, retaining talent, and all of these factors played a major role. So in effect, what we're seeing is commercial real estate had a short-term impact because just for companies to see how will these pan out, they needed some time. But importantly, if we see 21-22, especially the 22 April, May, June quarter, commercial leasing has seen a doubling of numbers year on year. If we see only this quarter, it's about close to about 90% growth. And if we see net leasing itself, which is supply minus the leasing part itself, net leasing saw a huge jump of almost 185% growth in the top 7 cities, with Bangalore leading with a 48% market share in India in net leasing. In gross leasing also, it's 30% market share of the total Indian leasing business. So these are the cities that we will see continue to dominate. In short, commercial offices will continue to do well. In fact, it's bounced back as predicted, bounced back at a really fast pace.
No, obviously, just I could see many companies forcing their employees to just come and join. And again, many companies have just been asking or just trying to just go with the social distancing so that they could just probably just take care if in case there is another pandemic.
Absolutely. In fact, the density of workstations is something that we are looking at very closely. India had moved the pre-pandemic period. We had increased the density of workstations. Global average is around the 100. India had already moved to about 55, 60. We see a slight reversal of those trends. May not be for too long, but largely what we're seeing is for most of these companies in cities like Bangalore, Hyderabad, Pune, Chennai, the amount of workforce they've hired versus the office space that they have, even with a hybrid work model, is just not enough. There's a huge shortage of office spaces. What leads to a cascading effect also is on the residential. So residential is a huge plus point. In fact, what we saw panning out in the latter half of 2020 to even right through 21 and 22 now is the surprise emergence of residential, where a lot of people had written off residential, saying, people will move back to their hometowns. That was a short-term temporary phase for certain segment of employees who could do that. But now, again, when things like pandemic pans out, the typical investor behavior has been to get back to safe
Absolutely,
segment.
that's right. And what you said is right. I could see some companies coming out of the stacking option. So many people, they just stacked up their items and then they just went to the thing. That's quite interesting. And you covered almost the basically the residential, commercial, as well as the co-working kind of a thing. And shall I just move on quickly to Mr. Aryaman? Aryaman, actually, just why don't you just continue adding your points as to just how the real estate market has been performing so far, and what is it likely to just perform in the coming years?
Sure, Vanita. So I think Nitin actually covered a lot of the points in a lot of detail, but just building on that a little bit, pre-pandemic, commercial real estate in India had become the blue-eyed boy or the preferred investment avenue for a lot of these private equity global funds. We were seeing a lot of these players take positions in India, and substantial positions. So that sort of facilitated a lot of foreign fund flow. Now, if we look at where we are today and we benchmark that to where we were, the fundamentals have not changed. So a lot of these fundamentals, again, Nitin had covered, but just to recapture the same, India is one of the few countries where, these MNCs are able to set up, where they have access to sufficient talent. All this talent is relatively affordable when you benchmark against, let's say foreign salaries. The $1 rentals, again, this is something very unique to India. And overall, the favorable market dynamics. So, this is what has really accelerated transition to India. Now, going forward, what we are seeing is that because of the pandemic, a lot of companies which otherwise may not have adopted, digital processes are transitioning overall to a more tech-oriented approach. Now, India being the ITS capital, again, Bangalore being one of the primary, hubs of technology, that revival is translating into leasing numbers. So, a lot of the leasing numbers are looking very positive. We are seeing pre-pandemic kind of traction again. In fact, all the pent-up demand over the past few years, because hiring happened, but the allocation of office space wasn't made. So, people were seeing, they were waiting and watching as to what the outcome will be. But now that things are returning to normal, now that, COVID is not as mystic as it was, people are returning to office. And, to accommodate all these increased employee bases that are coming back, they are drastically looking at expanding their, office space. So this is the overall sort of trend. We, in fact, in our portfolio, didn't see a single day of rent loss, rental discount, none of these things. So the reason to that is in times of distress, not only real estate, but I think in every asset class, your A-grade assets tend to remain stable, tend to, in fact, outperform as relative to B-grade assets, C-grade assets. So a lot of your distress is seen in the B and C-grade assets, but the A-grade assets tend to stand out, tend to differentiate themselves. And, we saw the same in equity markets, we saw the same in debt markets. And that same principle applies here as well.
That's great. And actually, just to add one more point, one of my friends is just running a senior citizen home. So when I asked her, actually, just it's a pandemic period, how things are going on like. So because she used to just let out the premise as well, because there are few investors. So she used to just let it out if in case some other senior citizen wants to just take it for a temporary period or for maybe for a few years. So to my biggest shock or surprise, she said just it was always fully occupied. So not only residential, commercial, maybe just a fractional investing, which did well during this period. Beyond that, even the other themes have also just done well. With this, actually, just over to you, Narayan. We need your views as to just how the markets have done and how it's likely to just do good in the coming years.
Going last has its own advantages. Nitin and Aryaman have covered most of the points, some of the points I wanted to discuss. But just to sum it up, if we step back, pre-pandemic, real estate, yes, it is a blue-eyed boy of Indian real estate, how it contributes to the economy and stuff. That's something which was always there. But if you see the sector is so strong, right? We had, first of the beginnings, I think we had something called an entity law. I don't want to get inside the technicalities, but it's the regulators that they came up with the entity law. Then we have the demonetization, we have the GST, we had the RERA, right? These are the punches and the blows that the real estate economy, industry got. Back to this, we had 2020 and 2021. Right? What it validates is how strong is real estate market in India, right? No matter 2020 and 2021 is something which was unexpected, but apart from that, the regulations which came across, right, be it demonetization, GSTs, and even the RERAs of the world, all came in to validate, cross-validate, and make the entire ecosystem very stronger, right? What we saw in 2020 and 21, like Aryaman said, right? All the tier one players, all the grade A assets stood out. They continue to perform. No, in the lease rent discounting or even from a leasing perspective, everything stood out. There was no default rates. I was speaking to a couple of developers who are from the leasing background, quite strong leasing background. And in 2020, all we could do is have a couple of webinars and understand as to what they're going through from a leasing perspective, if there have been any defaults and stuff. So everywhere it was a positive news saying that the grade A assets stood out. So that's one kind of a validation that kind of cross-related or kind of spilled over to the residential market. For every 500 square feet or 800 square feet of a commercial real estate space that gets leased out, one home gets sold or rented out, right? That was such a spot-on statement, which resonates to what happened in Q4 2020. I think the residential sales across the country peaked, and in South, I'm sure all of us are aware, everybody in Q4 of 2020 and Q4 of 2021 touched record sales. So, it's just I gave you didn't want to start off negative, but like I said, Nitin and Aryaman have covered enough. So I just wanted to give a pretext saying this sector is strong and it's here to grow, and it's going through a transition mode right now, paradigm shift. And I'm sure some of your questions, I'm hoping it'll cover that. So I'll throw some light there.
Sure. Thank you so much. I like the word Aasthy because in Tamil we call Aasthy as property. And Adish, do you have a question? Because I think we have garnered some questions from the investors. Obviously, we'll be taking their questions also from the Q&A pane. And Adish, would you like to take up this question?
Yes, surely. Thank you very much. The question is, can you quickly sum up the features of your alternative investment model? So there are so many investment models, especially in the alternative investment space. Now, I think we are slowly going towards a point where we have as many products in the alternative investment space as we have in the mutual fund space or other investment spaces. And I think it's becoming too crowded for all the crowded in our minds. So I'll quickly I'll quickly go to Mr. Nitin. Nitin, this is your question. I'd like to hear from you on what Smart Owner has in store exactly for all of us.
Yeah, so I'll take a step back as well and run through where we've grown. It's our 10th year. In fact, at Smart Owner, I myself have been here for 7 years of that growth, and it's been an interesting period. And when we started off, we were doing early stage investments into residential real estate, fractional ownership, very early stage. And we used to do investments right at the stage of land acquisition. And then typically a life cycle of a project as it goes through various NOC processes, pre-construction period, which is the most, if I put it that way, the most uncertain period. And then we used to manage those time periods and then subsequently, by the time the project is handed over, it's a 7 to 8 year period life cycle. We used to enter early and exit early prior to 2017. And 2018 onwards, we've moved on to the model where we also started commercial in 2017. And our experience in commercial was very simple. As tenants, you look at the whole commercial play from the tenant's perspective, and if you look at that, the two key factors that manage decisions for these corporates is the location and the specs. So if you're in the right place and you're providing some of the best quality grade A assets, as Aryaman was also mentioning, if you're giving them the best quality assets in the right location, then you will get top dollar for that office space. Big corporates, especially MNCs and companies who have a great profile, they're willing to pay as long as they're giving quality in the place that they desire. So those are the two key factors we look at in any of our products, be it commercial. On the residential, we have multiple options of getting into the investment space. One is through the fund itself. So we run a SEBI-registered alternate investment fund. We also have debentures of these residential projects that one could invest in during the construction period. So today, largely the investment opportunities that Smart Owner brings to the table of investors are during the construction period. So construction phase funding, largely residential. In the managed office space, we're providing opportunities right at the leasing phase where the tenant is already signed up or they're coming on board, and it's a fixed period of investment. And one could look at anywhere between 15 to 17% kind of a range of return on the commercial space that we have looking at. So two types of commercial investments we have. One is the managed office, and then you have the commercial grade A tech parks, so grade A office complexes, where again, we give these opportunities for investors to come in with a flexible ticket size, either at the completion stage, or we do also have a lot of opportunities at the construction stage. The key difference between these two is when you're entering at a completed phase, your cash flows are immediate. You start receiving immediate cash flows. When you're investing at a construction phase, your cash flows may be deferred by about 18 to 21 months. However, you get a better discount. You get a better pricing because you're getting at slightly earlier stages. So depending on the investor's needs, there are various factors that we look at. And one other key factor that you will see from Smart Owner's own projects is today, since 2017, we've only been funding projects that we manage ourselves, which is it's being done by our own in-house brand, Prime One Corp. So we have solutions even for end users. Let's say someone wants to buy a home for their own self-use. We have options for those as well. So it's a whole variety of products depending on the investor's needs, which we could always get into discussions at a later point.
I think that sounds pretty good. I think Smart Owner has a provision towards residential as well as a commercial real estate space. I think under commercial, you have managed spaces, and then you have the varied tech parks, and all that was described very well. Now I'm going to move on to Aryaman. Mr. Aryaman, I would like to ask the same question to you.
Sure. So, before jumping into the question, I'll tell you what actually led to our investment model. So there were three things that were going on when we started. The first was that, we were in the midst of a pandemic, and the perception around real estate was not ideal, or at least it wasn't in sync with what was actually happening in the market. But catering to our investor base, catering to retail users, addressing that perception was of, high importance. The second thing that was happening is your wealth segment, your debt returns, your corporate yields, all of these had deteriorated significantly. So, when you compare those to real estate yields, they were maybe at 50-60% of your real estate yields with no potential upside. So, when you, let's say, invest in a FD, you'll get your 4%, 5%, even 6%, but there's nothing above and beyond that. What we identified in commercial real estate is the fact that, number one, the cash flows are monthly. Number two, there's an underlying collateral, so it's not an unsecure kind of product. And number three, the fixed income, setting aside appreciation for a moment, just the rental in the form of fixed income was very, very competitive given today's landscape. So what we decided to do is focus on very, very core assets, especially in times of the pandemic. So completed assets in which the tenants had taken fresh leases, there was minimal vacancy risk, because it doesn't matter in which model you're operating in. If your underlying asset class is real estate, the inherent risks of the asset class you will have to deal with. So vacancy, releasability, and of course, liquidity. So our intent as an asset manager, our intent as a platform was to identify stable opportunities where we can optimize the upside for investors and limit the downside. So, that's the perspective we took. We wanted to ensure that we are able to give stability to investor profiles, which is the intent of real estate in times like this. So, going forward, we are looking at a variety of different investment products, variety of different parts in the real estate cycle, like Nitin said, you can enter into, you can invest into. So we are looking at all of those. But, we constantly evaluate the market climate to understand, what would be best to position to investors.
I think that sums up what we were looking at exactly. Stable opportunities with more upside and less downside in the commercial real estate space. Thank you very much. I'd like to pose the same question to Mr. Narayana Lal.
Sure. Before I answer the question, just a precursor for this, right, which is also the problem statement that Aasthy started with. When we look at markets with transparent real estate data points and stuff, where approximately any individual or investor has allocated anywhere between about 35 to 45% of their portfolio in real estate. Now, if you compare to that in India, as of now, the allocation is only at about 70 to 18%. Right? The gap, what we are talking about, 21 to 22%, is about $1.44 trillion. Now, this everybody knows it's an asset class which everybody. It's an asset class backed by sentiment, right? Indians love real estate, like the case with gold, right? So they love real estate, but the only problem that we had was people with money were able to participate. People who inherited real estate had sentimental roadblocks, so they never looked at it as a asset class for investment. And that's something which I tried to break in when I was intern, to advise clients how to invest in real estate, where entry and exit is kind of defined. Now, coming to Aasthy, what we look at is if there is a $1.44 trillion gap in the investment real estate investments in India, we understood that that's there because of lack of data. 2 is lack of accessibility, and 3 is something called social de-risking, where today if I invest in real estate, I'll probably talk to my friends, family, or extended brokers, right? So we realize that once we can crack this, then I think we should be able to get everybody to invest in real estate. So the first was data. Yes, for about close to about 1.5 to 2 years, we looked at data. We right now about 42 million data points plus and growing across India, where we look at hot locations where we compare demand, yield, and supply, and come up with our own algorithms to say that this is a location where there could be a good demand absorption. We are also working on data predictions and so on and so forth. So then once we identify the location, how do we let people invest with a small amount of money, right? So, and with the least possible risk, right? And that's where we realize these locations are definitely giving you some kind of an upside. But in real estate, the sentiments are, yes, from 2012 2013, a lot of fractional real estate companies have opened up, but still the mindset was a 25 lakh or a 15 lakh or even a 50 lakh is required for you to participate in the real estate investment. We kind of broke the barrier and said that you can start off as low as 5,000 rupees in real estate. Yes, 80% of our investments come more than a lakh. Yes, people invest about 40, 50 lakhs as well in our product. But what we have formulated is a pure capital appreciation play, where somebody enters at an X point and the exit is also defined. Right now, our products are where the exits are clearly defined and you get a certain, certain assured returns, right? But what we really want to unlock as we build our data side is to identify those tier 2 and tier 3 cities where there is a good potential for capital appreciation, and which is what real estate investments is all about in India, right? Somebody says, I bought this at 100 and today it's about 25,000. If we can really unlock that, and with small amount of investments, then that's the real way of unlocking real estate investments in India. And that's what we are trying to solve. And that's our model.
That's amazing.
Yes.
Yeah,
I think affordable investing is exactly what most of us are looking at, because all of us love real estate. Now, there are multiple ways of looking at it. Obviously, investing at a huge chunk is something that all of us will enjoy, because particularly in the real estate, all of us invest a lot of money because there's a lot of potential. And I think what's quite clear is that all 3 companies have different models very interesting models. I mean, Smart Owner has investments in managed offices and Grade A parks and the residential space, while Myre Capital has a very different outlook. They look for stable opportunities, and Aasthy look for opportunities where people can invest with as low as 5,000 rupees. That's very nice. And I think the level of growth that we're going to see in the alternative investment space will only grow because we've already seen a 26% year-on-year growth in that particular space. So sky's the limit from what I see. Back to you, Vanitha ma'am, for the next question.
Now that's really great because one is fractional investing facilitates a retail investor, a medium net worth investor, as well as a high net worth investor to consider, because gone are those days where the investor used to just borrow loan, right? So if they have a surplus of 10 lakhs, they used to just borrow 30 or 40 lakhs or a crore, and then they just keep paying the interest on that. So just when they sell the property, they have not calculated what is the kind of actual investment they have put in, including the interest. So if they have just taken for, if they have just made a down payment of 10 lakhs and just borrowed a loan of 30 lakhs. So just, and again, they have just incurred another 10 lakhs as interest towards a loan taken. So just imagine actually just, it's the cost is not a 10 plus 30, the cost is 10 plus 30 plus 10. So when they sell, they need to just ensure, right? So today, thanks to the fractional investing, whatever chunk they have, it can be 1,000 rupees, as Narayan said, or it can be a crore, or PMS demands 50 lakhs, or an NCD starts with 20 lakhs, or maybe a fractional investing in commercial space again starts with 10 lakhs onwards. It's really brilliant because it helps the investor to diversify the risk and have an allocation in their portfolio towards real estate instead of overcommitting as a loan. That's amazing. Coming to the next question, what kind of investors should consider investing in alternates in real estate? I think, let me start from Narayan this time. Narayan, what kind of investors should consider investing in alternates in real estate?
I'm going to take the most difficult question. I don't know if it's a question, in coming slides. And,
don't think that you're always a last bencher, okay?
So one of the most common questions, I'm not so sure if Aryaman or Nitin gets asked about real estate. Right? First is real estate, right? Okay, whether it's going to grow, there are oversupplied market, will I be able to sell? Will the tenant stay in the facility? Will he run away? I mean, all these questions are there. But one common question that gets asked in alternative investments is regulation, right? Now that's something which I want to explain and then answer this question. Is I just want to give you an example, right? Indian economy is the most robust today, if not for at least in the top 3, right? Now, the way economy is been growing, the government obviously have to make amendments and changes to make sure that the economy grows. Obviously, it's a democratic country. Government held a lot of things with themselves. Like, I'll give you a classic example of banks. Earlier, everything comes under the purview of RBI, still continues to come. Then there was an era of NBFCs, right? Then they came to, I don't know if people followed this, but in 2017, RBI came up with another regulation called P2P NBFC license, right? Now, without getting into technical stuff, what it says was that our government today is open to hear alternative ways of making economy grow, right? What I just quoted is the banking sector. Right, be it your food business, be it your delivery business, be it your logistics business, the road and transport, the Ministry of Road, Highways and Transport also making amendments to fit in the EV sector. Right, they have fitted in the share be it with the 2-wheeler or the 4-wheeler businesses. Right, so it's a paradigm shift that real estate is going through, and everybody knows that. Everybody likes real estate investments in India. Everybody wants to invest in real estate in India. And fractional investment from 2012 to 2013 is a validation of the same, and it's only here to stay. So fractional investment across asset classes, be it real estate or any other asset, we have about 20 plus players in India trying to do the same or doing extremely well. And it's just a matter of time that this will get regulated as well. Yes, all of us follow different different models, different structures to accommodate the same, because our visions and the returns that we want to give to our clientele is different. But at the end of the day, that's something which is will be regulated, and with the current regulations, whatever is there, it has all been fully regulated and accepted product. So that's my precursor for this question. What kind of alternate
investors? What kind of investors should consider investing?
Yeah. I think real estate as such, as part of a portfolio, we always recommend anywhere between about 20 to 24%, portfolio allocations when you're trying to create a portfolio, right? Earlier, that was a mindset when you had to invest a large amount of, ticket size. Now we are pushing people to make sure that we push anywhere between about 30 to 40% of their allocation. And since, the entry size is as low as what you guys just explained, right? We start off at the end of the funnel, which is, a lower part of the funnel, which is Aasthy, and we can go right up. 30 to 35 is what I would recommend for people to allocate with a mix of brick and mortar real estate investment and also alternative products.
And also you mean like retail investors, M&I, that is the medium net worth investors. Maybe when I say retail, your previous answer definitely just responded to this question, stating investors could start with as low as 1,000 onwards in alternate investments today. And in Aasthy, I've seen people could just invest even from 2 lakhs onwards kind. Yeah, that's great. And then over to you, Aryaman, this time a slight shift, okay? So I'll get back to you, Nitin. So Aryaman, over to you. What kind of investors should consider investing in alternates in real estate?
So see, the investors that at least we've seen are very widespread. So earlier, what used to happen is, let's start with the HNIs. A lot of these HNIs might not have in-house capabilities or in-house understanding of real estate. Now, in times like this, it's not as though they don't want diversification in real estate. It's just that they don't know how to go about it, or it's a very tedious process per se. So we've seen a lot of these family offices, HNIs, give us a mandate to deploy, X number of crores in 1 year, get them a diversified rent yielding portfolio. So, those are one type of investor. The second type, of course, is, high salaried individuals, people who want rental income. And, just on a off topic, Indians, what we've realized is love rental income. So, everyone wants a passive stream of cash flow. And this is essentially a way for them to build it. So this, I wouldn't say, alternatives becomes a primary investment avenue. In fact, we ourselves don't advise investors that if you only have a certain amount of money, put all of it into alternative. It usually comes after certain exposure in equity, certain exposure in debt. And this is a avenue via which people can diversify, people can build passive income, people can build non-correlated returns. But all of this comes once you already have the base portfolio ready. So, it's very important to first identify for an investor what their investment objective is, where they are with respect to building their portfolio, and accordingly evaluate. So it doesn't matter, like I mentioned earlier, alternative or not, you have to understand the underlying asset class and the attributes to it. So, real estate, for instance, you will have vacancy risk. It doesn't matter in what format. Today, tomorrow, 10 years down the line, vacancy could occur. So, one has to be cognizant of this. So it's not as though products with large or you can say outsized returns will not come with risk. It's only a matter of how you manage that risk, how you optimize that risk. And that's where platforms such as ours, such as, Smart Owner, Aasthy, Myre, that's where I guess all of us come in, where we can guide the investors, we can sort of manage that risk down. The investors that are coming to us are the ones who understand the value, understand why they should have real estate in their portfolio, but they don't know how to go about it. So that's effectively the kind of investors who are considering such alternatives.
Yeah, no, can really just understand. And as I just even told earlier, so instead of just borrowing loan, whatever actually just not even a plot won't be coming for less than 10 lakhs, right? So just obviously the 10 lakh is precisely something which is being accepted by some of the alternate investments. And over to you, Nitin. And you have to say just what is the minimum ticket size that your NCD wants, your PMS wants, or your alternate investment fund wants. You're on mute.
I'm now in that position where I have to answer after my co-panelists have finished most of it. So I mean, taking a leaf out of what both of them have said, totally agree with what they've said, and that's precisely why platforms such as our companies who are here started off, because real estate has been India's favorite asset class. It's been the HNI segment's favorite asset class globally. In fact, one of my interactions.
I'll correct a bit. You said it is a product of finite with individual. Average Indian investor, they love real estate. So just when they come to us for investing, they used to say, just I'm a conservative investor. Maybe when we raise the questions, when we ask them, actually, they would have heavily invested in real estate. So average investor, Indian investor is always a high net worth individual who has got heavy investment in real estate.
I think the perception of risk is very different person to person, and that's where advisors such as yourselves play a vital role in helping investors guide their asset allocations. And as both my co-speakers were saying, the asset allocation becomes very, very important before you set in the direction of investment in real estate. What you buy for your own self-consumption, like the house that you live in, should not be mixed as an investment in real estate. It cannot be used as an investment. So that's something that I'm sure all of advisors such as yourselves are guiding your investors in that direction. What then comes to the table of investments? It's very key to understand that you should have your base foundation portfolio. As we used to say, your core and satellite portfolio should be, core should be there. The core should always be set. And then you look at alternate investments, roughly a very, very ballpark rough is 1/3 of your portfolio into alternate assets. Could change based on each individual's objective and their end aim. But lastly, what one should understand in real estate is it is not going to be as liquid as your debt mutual funds or your liquid funds or FDs or even your other instruments. But one should be ready to wait for your asset to perform. One should be ready to invest time to let this deliver to its full potential. One good thing about real estate is, again, it's not that every real estate will perform equally. Like you look at one particular street in whichever area you're in, not every building, not every property, not every residential or commercial project performs the same as each other. Each one will have its own rate of growth. Each one will perform over a different, and you'll see this panning out over a 10-year period, 15-year period, where if you take Outer Ring Road itself in Bangalore, the growth between 2012 to 2019, largely for grade A assets, top quality assets, has been from 42 rupees per square foot rental to 85 rupees per square foot rental. Grade A only. If you don't look at them, the others have grown from the 42 to 65 to 67. So it ultimately boils down to which quality of asset you're looking at. One. Second is, what real estate will give you is, it will ensure that your range of return is more or less predictable as long as you pick the right quality. You'll not lose capital over a long-term period at all. It's a relatively safe asset class. Your predictable returns are there. And as Aryaman is also saying, it gives you a ready income, especially if you're in a commercial. You get you a attractive rental yield plus a superior capital appreciation. And if you take both into the scheme of things, it'll perform really well for you. And then, of course, we have options that ranges right from about 20 lakhs to excess of 1 crore for investors. It could depend on what each investor's need is, what their portfolio requires.
Now that's great. Over to you, Adarsh. And you all give a very clear picture as to just what kind of investors. So the answer is very clear, right from the retail investor who wants to invest money as low as actually just maybe, I think I could probably put it as a lakh, given the kind of speakers around us. The minimum investment probably could start with a lakh and it can just go on. Even if you want to shower a number of crores, you could do it. So over to you, Adarsh.
Surely. I think I'd like you to move to the next slide.
Yeah.
So there was actually a very important question that I'm sure that many investors in general have in mind, because all of us think about the risk involved in the investment. And I think, as Nitin just described, it is relatively less risky, but I'd like to hear from you on all the potential risks that this particular investment space has. So in other words, the question goes, what are the potential risks involved in this way of investing? And what are the ways that an investor can actually mitigate these risks? I think I'm going to juggle the order just like Vanita ma'am did. I'll go ahead and call on Mr. Narayana Lal to take up the question.
Sure. Now, like Nitin said, I think one has to understand or even Aryaman for that matter, right? One has to understand the underlying risk. Vacancy risk is one of the many. So, as a real estate product, as an asset class, there are risks associated with the underlying asset. But one such thing that we also did in Aasthy, if real estate is a asset class which has risk, how do we mitigate, right? So first we piggybacked on a data, right, which gives us a data saying, which gives us some kind of a direction saying, okay, based on our demand prediction, based on demand absorptions and stuff, how do we go ahead and shortlist a particular cluster or a micro market per se, what everybody's aware of. Then from there, we have the underlying product, and today the underlying product is being built by a developer in forms of commercial real estate and residential real estates, or even lands for that matter. So right now we are with the residential real estate for the capital acquisition play. With that, again, do certain amount of checks, due diligences, and so on and so forth, and also the timing, right? As much as we believe participating in the early part of the project gives you a good headroom for returns, but we believe that later part of the project or nearing completion project kind of adds a lot of validation. It helps us understand how the builders performed in terms of their financial repayment capacities and so on and so forth. So we believe that that is one of the critical areas where we could probably offset our risks, some of the risks that our potential investors might have, and also look at how much of an exposure that you would like to give away for one underlying project or one underlying unit per se, so that you're not you're not stuck with the particular project. Our intention is investors in Aasthy not necessarily look at a 25 lakhs or 50 lakhs in one asset, but we would like to have these investors invest like 5 lakhs across 10 assets across India and have a beautiful portfolio being created, again, from a risk mitigation perspective. So that's the approach what we have taken from an investor standpoint. I think what is very important for the investors is understand the structure very importantly. And I'm sure the panelists have their own ways of mitigating risk. They've gone through these, and that's the reason why we are democratizing it and fractionalizing to make sure that everybody can invest. So as long as they understand the structure and the mitigation plans or the steps taken by each one of these platforms, I think that should answer the question for the investor.
I think that sounds pretty good. I think a lot of the risk is managed through due diligence and checks, but I'd like to ask Mr. Aryaman if you'd like to add anything to this. Aryaman, you have to unmute yourself.
Sure. So in terms of the risks, there can be a number of risks depending on when and in what stage you're acquiring the real estate project. Now, again, when an individual, let's say, goes out and tries to do this himself, he'll need to have a legal due diligence team. He'll need to have a tenancy or leasing team to understand, the robustness of the current lease and, let's say, the mitigation strategy in case of vacancy. You'll need to have a team that understands the disposition of assets, understands the pulse of the market to really get an optimal appreciation at the time of exit. So, all these things require active management. Now, when I say active management, I earlier mentioned family offices and HNIs. Now, a lot of these people have the capital. They even might have the understanding of the asset class. But more often than not, what they might lack is in-house resources to holistically cover all these different areas of risk mitigation. So, for instance, today in-house, we have a full asset management team, leasing team, acquisition team, legal team, finance team. All of this is required to ensure that your risks are minimized. So that's effectively what we do. That's effectively how we minimize risks. I wouldn't say mitigate, but minimize risks. And that's really, the proposition, I guess, of all such platforms. We charge a fee in exchange of this risk minimization. So, that's how we add value. And the proposition is that we'll save theoretically, if not more money for investors than, from as relative to our fee. So that's the whole services aspect that we are providing to our investors.
I think there's a level of active management that's being done through adequate risk management mechanisms through various teams that you have within your company. I'd like to ask the same question to Nitin. Nitin, do you have anything to add to it?
Both Aryaman and Narayan have pretty much covered most of the aspects. Nothing much to add, especially with respect to the platforms that we're talking about. They kind of minimize most of the risks that one doesn't have the resources and time and access to information to mitigate on their own. That is achieved through platforms such as ourselves, the three that we are here today. That is achieved there. One additional point that I'd like to add to what Aryaman and Narayan had covered here is in the product or asset quality risk. That's something that we also looked at, and the reason why we also at Smart Owner got into managing projects ourselves was to try and minimize that risk of quality of asset on a long-term basis. And we have an in-house team that design is everything, and it's the quality of the set. When you choose a property in a particular area, you have a lot of options. In India, you have a wide range of projects in any particular location. So selection of the location is very critical. As my co-speakers were saying, selection of the right type of asset class is critical. Selection of the asset manager is also important after seeing what all they do at the background. And then finally, when you come to the project selection, you have to ensure that your product is superior in terms of what it offers in the same market to the, look at it from a perspective of the, if it's residential, what is it that makes that end user buyer come to your project than the neighboring project one and pay a premium for yours? If it's a commercial asset, what makes that big company, that big MNC, Japanese American MNC, to come and lease your asset in comparison to what's already available in the market, and for them to sign a long-term lease, and also your back-end resources. So design, architecture, and quality of the execution of the asset is also a very important factor in minimizing your risk on a long-term basis.
I think that sounds pretty good. I think understanding the structure, performing sufficient due diligence with checks, sufficient risk management mechanisms, and the long-term asset quality with respect to the quality of the asset and the design and its long-term sustainability are some of the things that I think all three companies consider in their outlook of making sure that the investment that the investors are making are safe and sound. Thank you very much for that. I'd like to hand it back to Vanitha ma'am for the next question.
Yeah, that's great. Actually, just what are the do's and don'ts that the investors should keep in mind when they just invest in alternate investments? So do's as well as don'ts, I would like to just hear from one and all. Probably let me start with Nitin this time. Nitin, what are the do's and don'ts that the investor should have?
It's in essence your investment selection process. That's what we are looking at here. So typically, one should start off with looking at the location, and selecting the right city and micro market is extremely important. You can't expect every micro market in every city to deliver the same. You can't expect every city to, there is no single question as how's Indian real estate performing. It's not we are in a country where it's not a democratic growth that every city will see. So one city will do better than the other. There's always going to be that cycle for different cities, for different micro markets as well. So selection of location at a micro and macro level are both important. Then selecting the type of the stage of project. So you, as an investor, you need to understand what your requirement is. You need to understand your own cash flow, which is where an advisor such as C Profit will play a role in helping you make that decision as to, do you need something that requires cash flow right now, or is your investment aligned towards looking at a higher wealth growth or profit growth on a long-term basis. These are decisions that you need to start taking before you look at investment. So that's another thing. Look at what your own requirement is. Select the right location, right city, and right micro market. Then look at the kind of project that you're looking at. If it's a residential, look at everything. Look at the design. Look at the type of amenities. Look at what the current buyer is looking at. That's important. The connectivity. Metro adds a huge plus point to your projects. Peripheral roads, ring roads, and upcoming infrastructure projects adds a huge value to these factors. Then another thing is look at also giving time. Investing time into your real estate portfolio is important. Any asset class will do well. as long as you give the time that that asset class deserves for it to deliver on your platform. So I'll let the others add to this as well, and let
That's
them add
great.
some points to what they could do.
Yeah, makes sense. Yeah, metros to a greater extent is this, what to say, minimize the burden of maybe just desperately searching a property today. And
Just one point, if I may add, sorry to interrupt, is there has been a lot of question that comes to us as you always look at tier one cities. Are you going to look at tier two cities? And that is what we look at Smart Owner at least is we look at where the lowest risk and more predictable return is. We're not looking at something that will deliver you 50-60% return in a single year. That's not what we are here to do. We are here to look at where you're, that, okay, you'll not get below 10 to 12% at all. Your range is going to be more or less in that 14 to 16% kind of if you look at commercial, it's both rental plus your capital growth. If you look at residential, your capital growth.
so average Indians scale out double-digit returns only.
Yeah. So the cities which will do that are the ones. Don't look at whether it's tier one, tier two. Look at where your risks are minimal and the long-term potential is there.
That's great. And over to you, Narayan. What are all the do's and don'ts that the investor should keep in mind really while investing in the alternate space?
I'll just throw open a very interesting conversation that I had with one of the investors. Then I'll answer this question. So, we had one of our investments options open. He really liked the opportunity and stuff. The first thing is, can I buy the whole asset, right? And that's my answer to this question, right? Don't have sentimental values. It's an alternative investment asset class.
I hope you're not hurting me.
No, I'm not. Like, it's not you, but one of the end users. So in real estate, one of the other words that goes in parallel is people get sentimental about it, and people think that, let me just go ahead and expose myself completely on it. What if, one fine day if I need it? What if, the what ifs come? As long as first you understand your own risk and see how you want to allocate, and if it is an investment strategy, stick to it. It could be in a tier two city. It could be a well thought through, strategy. Again, it's not a 60% return or a 16% return. Read through the entire structure, understand where the data comes into picture. Demand is the pioneer of everything today, right? As long as there is demand across, commercial, residential, or even co-living, whatever the underlying asset classes, that is going to be key. And try and diversify, right? And not take the jump in all approach, right? That quite happens with all of us, especially when it's real estate. As long as you stick to that and stick to your overall strategy, I think your portfolio will be good, and your diversification in true sense should work in real estate.
Makes sense. Very, very precise, and thank you. And over to you, Aryaman. And please just share your views on the do's and don'ts.
Sure. So in terms of the do, we always give one very strong advice to investors that irrespective of the platform, we have 3 here today, there are many more in the industry. What an investor should always look at, and that also agnostic of who the platform manager is the actual underlying asset. At the end of the day, that is what that they're going to be investing into. So it's not the tenant, it's not the asset manager. You really need to focus on what is the underlying asset, what is the capital value I'm acquiring at, what is the proposition of this property. Once those check boxes are met, yes, then the other things become a lot more relevant. But, taking decisions for the incorrect reason is something that, leads people into not being happy with the investment. The asset manager also not being able to service the investor because there's a misalignment of expectation and what they've invested into. So that's the biggest advice I would say for people looking to get into alternatives, is that truly understand what is the proposition at hand and don't over allocate. These are alternatives, they are not primaries. Primaries are mutual funds, they are debt. So yeah, to that end, when getting into alternatives, do it with a very conscious, viewpoint, taking into account all the different parameters.
Oh, that's great. And the lessons are very clear. Look before you leap. That is, every investor should do the basic homework. And when it comes to the investor who approaches the advisor, we always do our due diligence, and we also just do a complete property audit wherever it is a fractional investment, or even if it is a maybe an investment vetted by SEBI, say like a PMS or a alternate investment fund. For everything, actually, just we do our due diligence, and you could always check with us. And other one is diversify your portfolio. Even when it comes to real estate, fractional investing or the alternate investments in real estate just literally just gives you very huge opportunity to diversify the portfolio. Gone are those days where you used to just go pick a plot and say, just there is a litigation. I have got into this without knowing. So gone are those days. So today, actually, just these kind of opportunities knocks your door and literally just gives you to diversify. So better make best use of it. So that's one thing. And I think that Adarsh has got something in store. Is it so, Adarsh?
Yeah, we actually have something very interesting in store right now. That is we actually have a poll, right? Do we have a poll? I think, yeah, we have a poll in store.
Yeah. Just, can I launch the poll? And with me, I have Devrajan.
Hello all, good morning. A warm welcome once again. Let's have the quiz and within a minute. So let me launch the quiz. So here you go.
The question here is, in the year 2021, investments in alternate real estates increased by how much percentage? I think I leaked the paper already. Guys, spruce up. Yeah, 100% of 100% answered. So 26, that is close to around 50% of the investors say like 26% is the actually just the incremental growth in the alternate investment space in the real estate in 2021. That is a whopping growth. And 50% people have said 40%. I think the people here would be very glad had it grown by 40%. And I hope that it will happen in the coming year. So let me stop sharing and let me go to the next question probably. And over to you, Deva, poll number 2.
Yeah.
The most likely.
The most likely returns that Indian real estate market could deliver between 22 to 27 is, and the choices are 6.2%, 9.6%, 15%, 8.4%. Yes.
38% participated. Too soon.
Yeah, here we go. The result is 40% have voted for 9.6% and 60% have voted for 15%.
Now, again, the leaders here would have been excited, would have literally got excited had the returns been in the range of 15%. I hope it will deliver in the coming years. So I think for this also, I leaked the answer already. It's 9.6%. And so maybe just that is a kind of forecast that we have on the growth in the real estate market between 2022 and 2027. Let me stop the share and actually just Adarsh, what else are we planning for the day?
We actually have an interesting round at this point of time, and this is for all the panelists involved here. We have something called a rapid fire round. I'm not sure if any of you are aware of it. It is one of those rounds where I'll pose a question to one of you, and you have to answer that question in a word, or probably even less than that if you can. So for the benefit of everybody in the audience, so there is a rapid fire round to repeat. So yeah, we have a bunch of questions. We have a total of around 15 questions. Now I'll be posing a question to each and every one of them, and each panelist will have to answer the question in a word or probably a sentence at max, not more than that. So I'll move on to the first question. Would you mind displaying the first question, please? Yes, my first question is to Nitin. If you were given an option to invest 1 crore, in which city would you invest? In 1 word or less.
This is for speaking for ourselves, right?
Yes, it's a rapid fire round. You have to answer the question in a word.
Bangalore.
All right, next question. My next question is to Mr. Narayana Lal. The question is, prioritize the city preferences in order in which you wish to invest. So the cities are Mumbai, Chennai, Bangalore, and Hyderabad. I want you to rank these cities as per your preferences.
Bangalore, Hyderabad, Bombay, and Chennai.
Thank you for that. We'll move to Mr. Aryaman now. What is the growth rate forecast in real estate for the next 5 years? What is the expectation?
10 to 12%.
Thank you very much for that. I'll move to the next question now. We'll move to Mr. Nitin again. If you were given 1 crore to invest, how would you bifurcate between residential, commercial, and co-working? To repeat, if you were given 1 crore to invest, how do you bifurcate between residential, commercial, and co-working space?
1/3 in each.
1/3 in each. All right, I think that's a pretty wise answer when you think about it. I'll move to the next question. I'll move to Mr. Narayan. Can we move to the next slide? I think there's a technical difficulty.
Okay.
Yes, here's the question. Can we pledge and take a loan on your investment? Is that possible? Yes or no? Can we take a loan on the investment we make through Aasthy? Yes or no?
No.
No. All right. Simple question, simple answer. We'll move to the next question. And this question is to Mr. Aryaman. What is the growth you expect to see? I think there's a repetition, I believe. Oh, no, wait. What is the growth that you wish to see in the real estate space in the next 5 years?
I think probably we can take this question to Nitin, as Aryaman has already answered.
Oh, all right. I think we can ask the question to Mr. Nitin in that case.
I agree with Aryaman. It's in the 10 to 12%. We wish it would be higher.
All of us wish it could be higher, probably around 14 to 16% at least. But I think there's a lot of potential there. Now I'll ask, here's the next question. And this question is to Mr. Narayan. Will the next budget be real estate focused? Yes or no?
I think one way or the other, it's always been focused towards real estate. Now, it really matters which end of the spectrum are you and how you're taking it. So yes, the answer is yes.
Yeah, 80,000 crores have been allotted in this budget to infrastructure alone. So that says really it is focused, but probably just Adarsh would have just wanted to know what way actually just alternates or getting benefited. So.
Okay, now this question goes to Mr. Aryaman. Assume that your equity portfolio delivers 20%. Would you still consider investing in the alternate real estate investment space? To repeat, assume that your equity portfolio delivers 20%. Would you still consider investing in the alternative investment in the alternative investment real estate space?
Yes. So NAV versus cash flow.
Very precise here.
That's quite clear when you think about it. Yeah, I think you had a very, I think you took a safe route and you answered the question. Thank you very much for that. I think that helped all of us. Next question goes to Mr. Nitin. Should the bond fund investor consider alternate asset investing? Yes or no? Should a bond fund investor consider alternate asset investing? Yes or no?
Yes, as long as he or she has the time to wait for at least a 4 to 5 year period. Yes.
Even more precise.
I think all of us heard that, 4 to 5 years. Next question goes to Mr. Narayana Lal. Will there be a decline in the real estate prices given the global cues? Yes or no? To repeat, will there be a decline in real estate prices given the global cues, current global cues? Yes or no?
Your real estate investments that you make, you'll have to wait, give it some time. If you're expecting the assets to deliver like in short-term gains, definitely that's not the answer. So yes, I mean, in a long-term perspective, it will not decline.
I think that is the best way to possibly put it, because no investment is going to deliver instant returns. There'll always be a period of decline and there'll be a period of upside. And to experience the upside, it obviously takes a bit of time. So that comes with patience at the end of the day. Do we have another question from here or are we done? I'd like you to move to the next slide in case of there's one.
No, this is the next question. Will the alternate investor
Oh, yes.
be getting?
Thank you very much for that. Now, my question here goes to Mr. Aryaman again. Will the alternate investor in real estate be getting both appreciation and rental? Yes or no?
Yes.
Yes. All right. Next question, please. Now, this question goes to Mr. Narayana Lal. What is the market share of your company in the alternate investment space? Now, it's a very technical question. You might have a very hard time answering it. I'm just going to give you the freedom to even
Why don't
think
we take this question to all others?
I think we can actually ask this question to all three of you. We'll start with Mr. Narayana Lal, then we move to the other two.
I'm going to sound like a typical cliche co-founder. In the capital appreciation play in real estate, in alternative investment space, right now we are the first movers, so sky is the limit. So I may not be able to give you a number here, but yes, we are at a single digit right now. But yeah, that's the open space that we have.
Now I'll move to Mr. Nitin now.
Unfortunately, it's not a one-word answer for this. So when we started off in 2012 in fractional ownership in residential, we were the only ones. So in South, we had 100% market share, but it's good to have people on board now. The competition is good for the industry. So now it's unfortunately, we don't have 100% numbers for this since it's unlisted space. You don't have the exact numbers. But we still believe we are almost there in terms of half of it, half of the market share in the South market. But it's good to have more players coming in this space. It makes it healthy for investors to choose between options.
I'm going to move to Mr. Aryaman to answer the question.
Sure. So even my answer will be slightly longer. So, overall, when creating a new category, the market share in terms of your peers or competing platforms is not very relevant. The market share with respect to the underlying asset class is a far more important metric. So, today maybe 1,500 crores, 2,000 crores, 2,500 crores is the max. All the platforms together, would be managing. The real estate sector is way larger than that. If you see foreign countries with mature fractional ownership categories, they're single platforms managing billions of dollars. So I think where we are today, it's, market share is a very, I would say, negative term when you compare with each other, because the goal has to be a lot bigger. And that's really how the category will mature and formalize in time.
Absolutely. Sorry to interrupt, but
yes,
totally agree with Aryaman that, with more players coming into the space, it only means that investors are getting a lot more aware. So your entire base is getting bigger. So that's a good thing for Indian investor community.
I think in general, there are multiple options right now to invest in the alternate real estate space. There are multiple options that are being offered by all three companies involved here. All of them very unique in their own way. And I think all of us will have the opportunity to sit down and discuss about that sometime after the meeting. Now we'll move to the next question. Now, this question is I think this is a question that I can probably ask to all three of you, or maybe one of you, in case if you're interested. The question is to Mr. Nitin. The question is that
the answer is going to be one and the same, so it's better.
The answer is going to be pretty much the same. I think, is there liquidity in the alternate investment space?
Liquidity is there, but it shouldn't be confused with immediate liquidity within a day or two. Give it some time. Yes, there is much better liquidity today than it was 7-8 years back.
I think that's quite clear, because at the end of the day, I think the level of risk that's involved is obviously being mitigated by the level of risk management mechanisms that are being implemented by all three companies involved here. And I think that in its own ensures a bit of safety and also offers a bit of liquidity. But as you said, there is nothing called immediate liquidity in this space, because in any space where you're looking to get a 10% return or more than that, you cannot expect instant liquidity. Now,
and the good thing about the Indian real estate is it's getting a lot more regulated. So that's a good thing for the market in the long run. So there's clarity as well.
True, that's
all right. I don't think the other speakers would have anything to say for that. I'm pretty confident that all of them would have the same answer to the question. Now I'll move to the next question. And this question is to Mr. Narayana Lal. The question is, which is subject to highest risk? Which asset class here is subject to the highest form of risk? Equity, real estate. I think you must go back to the previous slide again. Yes. As I was saying, which asset class here is subject to the highest risk? And I want you to rank them or put them in order. We have equity, real estate, and bond fund.
I think it's a correlation to the holding period, right? If held for a longer period, I think this will stabilize. I think like one of the articles I was reading the other day, equity, my first instance was, I was about to say equity, but 1979, Sensex also was at 100. Today we are at what we are, right? But if you look at the graph, the ups and downs, if you average it out, it gives you a strong number. So I will be biased if I say equity, though that was my first reaction. So it is directly correlated to the number of years of holding. So
yeah, all right, then I think that sounds pretty good. I'll move to the next question now. Now, this question is quite the opposite compared to the previous one. I'll pose this question to Mr. Aryaman. The question is, what asset class here do you think is subject to the lowest risk? We have gold, alternates, and real estate, and bond fund. I want you to rank them.
So, risk is a bit subjective. It depends on how investors define risk. If the risk is loss of, let's say, capital, then I would say maybe not pure bond funds, but let's say levered bond funds, your risk might be there. Otherwise, gold and real estate, let's say with no leverage, they are hard assets. So your capital preservation is there. If your risk is loss of, let's say, revenue, loss of rental, then maybe bond funds are less riskier than real estate. So it really depends on how an investor perceives his risk. To me personally, I would choose gold, but that's just me personally.
I think that's actually a very multi-dimensional way of looking at it. And I think all of us understood where you were coming from at that point. But of course, gold might seem like gold might carry the lowest form of risk given the sustainability that has had over the years. So this is the end of the rapid fire round. Thank you very much. I'd like to thank all the panelists. I think it was quite a challenge because you had to go from speaking 1,000 sentences across 5 minutes to speaking one word. So thank you very much. I'd like to hand it back to Ms. Vanitha for the.
Really, thank you so much. It was really brilliant. And I think that investors would have just gained much better than whatever they would have got otherwise by just reading the articles and all. It was an immense knowledge that you have shared today. And with this, actually, I think I need to take 2 or 3 more polls to make it even more interesting. Over to you, Deva.
Yeah. Okay. Let's launch the poll number 3. What kind of returns you feel an alternate investment could deliver on an average? Option 1, 5 to 10%. Option 2, 7 to 8%. Option 3, 10 to 15%. And option 4, 25 to 35%.
Can we add this question to the rapid fire as well, Adarsh? Because
all right, once we are done. Okay, you know what? Before we
participated.
I think before we unveil the answer, yes, apologies for interrupting, Deva. I think before we unveil the answer, we can probably add.
I think there's some.
Around 39% have participated. Yeah, the question here is, what kind of returns you feel an alternate investment could deliver on an average? Is it 5 to 10? Is it 7 to 8, 10 to 15, or 25 to 55%? Yeah, probably let's end the poll.
Yeah. So,
all right, then we'll pose this question to the 3 panelists before we announce the results. I'd like to go on to Mr. Nitin. What do you think the answer is to the question?
I want a 5th option called 15 to 18%.
Thank you very much. Apologies, we cannot actually have that option there. I wish we could. 15 to 18%.
But the upper end of that band of 10 to 15%, basically the 14 to 15 would where it would fit anyways. Yeah.
Okay.
10 to 15%. I would like to pose the same question to Mr. Aryaman.
I would say, agreeing with a lot of the investors, 10 to 15, that would be the safest bet.
Now to Mr. Narayana Lal.
I would say 13 and 14. Yeah, go with the investors. The same bracket.
Okay, I think for the most part, all of us agree on one option, and that is 10 to 15%, but I'm going to let Deva decide on what the answer is.
Yes, the maximum number goes with 10 to 15% with 75%. Let me go on to the next question. Alternate investments in real estate. Reduces the management risk, delivers superior returns for low investment, all of the above and none of the above.
Only 30% have participated so
yeah,
far.
I think numbers are getting increased. Still, people need time. Okay, let me end the poll. So the result goes with all of the above. 91% is voted the same, and the answer is right. We'll go with the final question. How much percentage will you allocate investing in alternate investment, real estate in your portfolio? Options are 2%, 5%, 10%, 20% or more. Here you go. %40 people have participated, expecting more.
If you remember, actually, just Nitin said probably he would add 1/3 of his portfolio to alternates. And I think Narayan said around 35% of his portfolio. So
let me end the results. Okay. 50% have mentioned as 10% and 40% 20% or more.
That's great. So just people have just told that they would allocate on an average more than 10% of the overall portfolio. That's great. And then the time has come for us to just take the questions from the Q&A pane. And maybe if an investor is interested, they could also just maybe let me stop the share. We could also just maybe write, if you want to just unmute and talk, just let us know. You could raise the hand. Accordingly, I could just unmute and just allow you to talk to the speaker. And I would appreciate in case you want to just mention the speaker so that we can just allocate to them time. Just give me a moment. Okay, the first question is, what is the learning from the real estate crash in China? China or US or India? What is the learning from the real estate crash in China for US and India? So that's a question, and it's answered. It's asked by Mr. C.S. Shankar. Over to you. Sorry, this is being asked by Vani Sunil. Very sorry. Vani Sunil, would you like to just raise this question? Can I unmute and just allow you to talk? Yeah, there you go.
Yes, hi Vanita. Yes, I would like to know what's happening in China against what would happen in India in future, say from 5 to 6 years from now, with these alternate investments in real estate.
Fine. So to whom you would like to shoot this question? So Nitin, can you take up this question?
Sure.
Yeah.
So one important thing to also understand is all three markets are very different in fundamentals, and US, China, and India are all three very different fundamentally. Important to understand that in India, if you look at it largely, looking at the housing sector itself, more than 80% of the population of India is yet to buy their first home. So which means your potential end user market is so huge, and we are the most populous country globally. So the potential to just deliver housing to these many people is fundamentally a strong reason why Indian real estate has a fundamental reason to grow well in the long run. Second is again something that we were discussing earlier. If you look at the commercial also, there's a reason why even during the recession, it's the outsourcing that grows. The cost cutting for the majority of these companies, including the Western markets like the US, they look at cutting costs. And the more they think in terms of outsourcing, the more they're thinking towards allocating funds and resources towards countries like India, where it's high quality talent at a very relatively cheaper cost, relatively inexpensive real estate. So their allocation towards more offices in these countries is going to happen. So that's a fundamental reason why you'll have a better job opportunities in the long run for Indian markets, and certain cities like Bangalore, Hyderabad, Pune, Chennai, more than the other cities one. If you look at the home loan numbers as well from 21, 22, one of Mr. Deepak Parekh also did mention that for the first time in his entire career of 40 years in the housing sector, housing finance sector, he saw end user market. There was a truly end user market that was buying properties and not investors. It's more of end user market that's buying properties for the self-use. That is an important number that we need to look at, which means that bottom line, Indian real estate has a strong foundation for it to grow for the next decade. So we will not face the same type of situations that US and China faced. Very different markets. China had artificially created cities subsidized by the government. In US, you had a very high leveraged borrowing for multiple investments. So those things are not linked to Indian real estate. So we're very different from those two markets.
Yeah, the very next question is being asked by Mr. C. Shankar. How much was the returns on rental in the COVID period between 2021 and 2022 for commercial rental space? Actually, just Aryaman, could you please take up this question?
Sure. So in terms of the returns, at least first I'll talk about our portfolio. So, we actually built a large part or majority of our portfolio in 2021, 2020. So we've been able to deliver, exactly what we projected, upwards of 8% rental yields net being distributed to investors. That's post all fee, post expenses. With respect to appreciation, yes, basis valuation report, there has been unrealized appreciation. But the realized appreciation would be a better indicator, which we will see in the coming few years, once sort of these projects reach their time of exit. But overall, we didn't see any deviance from what we had anticipated the returns to be. And even I think in the general real estate space, the similar principle holds. Properties which are A grade, which have low vacancies, tenants are not leaving very easily simply because they know that tomorrow, when things go back to normal, they might not get office space in that same development or the same premises that they would otherwise want. So, we are seeing that kind of stickiness to A-grade properties, and hence the returns have not been significantly impacted. I mean, landlords based on personal preference may have given 1 month of rent discount, 3 months of rent discount during lockdown period. But, I don't think anyone has really struggled who are landlords of A-grade properties.
Mr. C. Shankar, would you like to elaborate on the question, because you would like to understand the kind of impact the recession is going to have on the economy? So would you like to continue with the same question, Aryaman, because it is a question actually which is again from Mr. C. Shankar. It's a continuing question. Mr. Shankar, I have unmuted. Would you like to talk? Okay. So he would like to understand as to how the recession is just is an impending in US and UK. How is it going to just affect the commercial rental space since there could be slowdown in IT hiring? So that's what he wants to know. So,
So, in terms of IT hiring, it's less driven by organic growth today. It's more driven by expedited adoption of digital processes. So, what we are witnessing today is a little bit inorganic. Because of the pandemic, people have realized the importance of integrating digital processes. So this is something that in, let's say, pre-pandemic would not have been at this accelerated a speed, but it is today because of, what we've been through in the past few years. More importantly, hard assets such as real estate, such as gold, commodities, all of these are hedges against inflation. They're inflation linked. Returns are inflation linked. So in times of high inflationary pressures, which is what is happening today, you see investors increasingly gravitate towards such safe havens, if you must call it. But that's why you must see, gold prices going up, real estate prices going up in times when inflation is sort of pushing double digits in India. So, this is the overall sort of overview of the real estate market with respect to recession. And, in my personal opinion, we've already been in a recession. It's not as though we are not. We are seeing a different version of recession because this is being artificially supported by governments, by, for example, the US Fed printing of more currency. So we are in a sort of managed recession. And again, your better assets, your A-grade assets, not only in real estate, but across the board, are tending to hold strong, even in turbulent times. So even if you see the bond market, debt, FD, equity, real estate, all the good assets are sort of keeping their hold during such times.
Yeah, it's now, as he said, just probably it's probably the government is well prepared for this recession, and it was also a foreseen recession. And as such, actually, just almost all governments have been planning since 2019 is what I could just clearly just understand. And the subsequent question is, he just wants to know whether they give a monthly rental and monthly rental share or one-time capital appreciation is that he wants to know. And can I take this to Narayan?
Sorry, the last part of the question was he wants to know whether he wants to go with the monthly rental.
He wants to know whether the returns that is being shared with the investor is as a monthly rental or as a capital appreciation.
It's for Aasthy specific product specific thing, it's a capital appreciation.
Yeah. Mr. Shankar actually just as a lot of actually just alternate investments have just come in space. We will also be just rolling out our maybe just personal videos to get an understanding more on the product, because whatever question you have raised is very product specific, and some of the alternate investment products just gives a monthly rental as well as appreciation. Some gives either of the one. So just it demands a bit more understanding, and we will also just make you understand on the kind of products that are there. Apart from that, we'll also be rolling out in the coming week on some kind of product videos. And yeah, Mr. Santosh Murthy, actually just already this question has been raised, or if you have a further more question, can I just unmute you so that you can raise it? Mr. Santosh Murthy, over to you. Because you have asked a question on how is the recession, which tentatively predicted to hit India. Actually, I think it's not going to hit. It has already hit, and we are midway through. Yeah.
I believe it's already been answered. It's more clarified. I just wanted to understand how it's the recession would affect. I believe it has rightly been answered, and you also clarified it further. Thank you. Thank you for the clarifications. It was a nice session altogether.
Thank you so much. If I'm right, actually, just we are halfway through with the recession, and really, when it comes to UK and US, it is not at all as such. And maybe another question from Mr. Shankar again. I will invest 20 lakhs. Will the investment be spread across projects or concentrated in one project? And Narayan, can you take up this question as it is more related to you? Because Mr. Shankar wants to know that if I invest 20 lakhs, will the investment be spread across projects or concentrated in one project?
So our platform allows today for the investors to choose the different assets which come on our platform as and when we go live. So he can choose the the assets that he wants to invest, and these assets could be in Bangalore, future it could be in Hyderabad, Pune, and so on and so forth. So the automatic asset allocation one-time payout we don't do on the back end. This happens at the investor side.
Yeah, it again depends on the kind of product that you're choosing. I got multiple products, which that is we could advise, and you could also just probably pick those kind of products. You could just diversify by putting in different
There's
baskets.
a lot of lag. I'm not so sure if I'm the only one experiencing this.
Yeah, I thought even I was experiencing. Just 1 minute.
Yeah.
In a moment.
Yeah. What are the minimum investment involved in this space? Is what actually just Suman wants to know. Am I audible? Am I sounding better? Am I audible to all?
Getting better, Vanita, if you could just say something.
Yeah, what is the minimum investment involved in the space is something Suman wanted to know. And Suman, again, actually just there are multiple investment products in the alternate space. It depends on your investment horizon, the kind of risk taking ability of yours. And then again, the kind of investment amount you want to put in. And of course, right, minimum, as Narayan rightly said, just it starts with anywhere, even from 1,000, and with many of the counters, it starts with 1 lakh, and sky is the limit. There is no upper limit.
I think there's an issue with the audio once again.
We're not able to hear Ms. Vanita.
Is it so? Adarsh, would you like to take up?
Yeah, I think it'd be, I'm not able to hear you actually.
Yeah, why don't you take up then?